Hey guys, we're back again reviewing another income ETF. We're back with another NEOS product. Can we just take a second to acknowledge how good some of these NEOS products have been lately? Like, just taking a look at their ETFs out here, like we got SPY, Triple QI, IWMI. These are all really good income ETFs that have really impressed so far. I've also had a lot of requests to do one on the QQQH and the SPY-H, so those videos might be coming soon. But today we're going to be taking a look at IYRI. This is the NEOS Real Estate High Income ETF. You guys can see they're giving close to a 12% dividend yield every single year. That'd be close to a 1% return every month, which is pretty incredible. So finding steady income, it's definitely top line for most people. Let's get under the skin of IWRI. This is a brand new ETF. It hasn't really been around that long. It's actually launched in January of 2025, so a brand new ETF. Still not too much data that we could go based off of, but its performance so far is quite impressive. So let's hope that it could continue this track. So what does this ETF do? Well, it's going to be aiming for high monthly income with some growth options through their, of course, they got to use these terminology, right? Their data-driven call option strategy on ETFs that seek to track the Dow Jones U.S. Real Estate Capped Index. So this is designed to track the performance of real estate investment trusts or REITs and other companies that invest directly or indirectly through real estate. And there's all types of different types of real estate, right? There's developing real estate, there's management of real estate, there's of course the ownership of real estate, and basically, the capped part means that it's ensuring diversification among that index. When we look at some of IYRI's top holdings, we get companies like Prologis, which is about 8% of the fund. This is a really big warehouse company, logistics and warehouse company. We also have American Tower at 7%. This is a cell tower company. And then, of course, we have Welltower at 6.63%, so almost 7%. And this is a assisted living and senior housing company. So real estate, guys, you guys know I'm a big fan of real estate. I've done a lot of research the last 10 years on ways that people make their wealth. What I've noticed that there's a very common trend is that millionaires, they often own real estate. They are often invested not only in their own homes, but other real estate investment products. So that could be REITs, that could be crowdfunding. This is just another way that you could get access to something that rich people do, and that's getting exposure to real estate. I love real estate because it's going to be existing in any condition. You can't outsource it, right? People are always going to need a place to live. They're going to need a place to do business, to eat, work out, anything else that's associated with real estate. It's all around us. So just looking at their holdings, guys, they have 71 different holdings. Their top 10 make up about 47% of the fund. So it's a little bit diversified, but just in the real estate sector. And they're definitely focused on established blue chip companies. So these aren't going to be super small mom and pop real estate companies. These are the biggest companies that pay out the juiciest of dividends. So this could be a great ETF for somebody who wants exposure to the real estate sector, but doesn't want to directly own real estate and all the hassles that come with managing real estate yourself. Guys, nobody wants that 2 a.m. call about one of their tenants saying that, hey, the toilet is clogged. Can you come take a look at it? Well, I don't think you want that call at any time of the day, but definitely not at 2 a.m. So this is a way to get passive exposure to real estate, getting nearly a 1% return every month. It sure does sound cool, since that is the true passive income. That is where the true wealth is going to be built. But just remember, dividends, they are never guaranteed. Just because the fund has done pretty well so far in about the 5 months that it's been out, it doesn't mean that it's always going to do well. We're going to take a look at the risk here in a little bit. But again, guys, this could be a way to complement current REIT holdings, right? Just because you own REITs already, that doesn't mean that this doesn't have a place in one's portfolio. It's just another way to get diversification with real estate. And we haven't even talked about their strategy yet, right? They're doing call options. This is what makes it unique. It's not just a real estate investment trust. They're also doing covered calls. They sell call options on other ETFs that track the Dow Jones U.S. Real Estate Capped Index. A reminder on what are call options. Well, a call option basically gives somebody the right, but not the obligation, to buy a stock at a set price called the strike price before a certain date. Now, what does IYRI actually do with this? What is their strategy? So they are going to be buying REIT stocks. They hold a portfolio of REITs, real estate investment trust. We already went over a couple of them, but just remember they have companies like American Tower, Prologis, and then they sell call options on those holdings. So if they sell call options on ETFs or stocks it owns or that track the same index, this is a covered call because the fund covers the option by owning the underlying asset. And then, of course, the part that you're most interested in is they collect the premiums. By selling those options, IYRI, they're collecting cash upfront, which is called the premium, which is passed along as extra income to us investors. I will give an example here. So let's say IYRI, they own a REIT ETF trading at $50. If it sells a call option giving somebody the right to buy that ETF at $52 within a month, the buyer pays a premium, say $1 per share. But if the ETF stays below that $52 strike price, the option will expire worthless by that date. And IYR, they get to keep the premium. If the price, though, does go above $52, IYRI might have to sell it at $52 and give up all that upside. But it's still profiting overall if it doesn't go up too much. Now, what are some of the benefits of doing this, right? There's extra monthly income on top of already the big juicy dividends that REITs often pay. Remember, real estate investment trusts, they get special tax breaks from the government, but in exchange, they have to pay out at least 90% of taxable income to the shareholders. That's why you often see REITs with super high, ridiculously high yields. And of course, it's going to give smoother income streams. It's great for income-focused investors. Now, of course, that does come with some downsides. As we talked about, it caps the upside. If REITs rally really strong, which real estate has done very well to start off 2025 compared to other sectors, IYRI, man, I have to come up with a better abbreviation for this or an acronym. What if we called it like IYRI? Yeah, I like that one. IYRI might miss some of that growth. That's because they are selling away some of those rights in exchange for those juicy premiums. And of course, we still have all that downside exposure. If REITs don't do very well, like they haven't done very well in some more recent years, a call premiums only partially offset some of those losses. Overall, guys, bottom line, the covered call strategy adds steady income. It's a steady income stream and it reduces volatility, but it also sacrifices some upside potential. It's really good for income seekers who are okay with some slower capital growth in exchange for higher monthly income. The fund may also do some flex options, which is basically tailor-made options for their risk appetite, such as the strike price or expiration date. It's basically negotiating options they're doing, and it's actually used by NEOS quite a bit. They may also employ some call spread strategies as part of its options overlay, and this primarily involves writing or selling covered calls on ETFs tracking the Dow Jones U.S. real estate capped index. They're selling a call option at one strike price, and then they are buying a call option at a higher strike price. The strategy basically limits both potential gains and losses, which creates a net credit or income while capping the upside. Now, of course, you saw that really high dividend number, that nearly 12%, but you should know that some of that is going to be a return of capital, which will temporarily defer taxes. But remember, those tax consequences will be impacted later. Now, ROC isn't inherently bad. That's why you just need to hope that there's not much NAV erosion. We haven't really seen that much NAV erosion with this fund so far, right? They launched in January. They've been having a pretty good year, real estate has, and there's only about -1% of NAV erosion. And they have paid out some pretty big, juicy dividends so far. For reference, VNQ, the Vanguard Real Estate Index Fund, it just basically tracks the biggest REITs out there. They so far year to date have went up 1.37%, but they are not going to pay as fat of a juicy dividend. When we compare the two since the start of IYRI, that was January 15th of 2025 this year, IYRI is actually outperforming so far. They've returned 4.8% compared to the VNQ's 3.81%. But just also remember that VNQ has a super low expense ratio of just 13 basis points, but NEOS, they're going to have a higher one since they are just a smaller company. They have an expense ratio of 68 basis points. That's going to be $68 for every $10,000 invested. I know that doesn't sound too high, but after years of investing, that does add up. But you have to remember this is actively managed, so I do expect NEOS to, of course, have a higher expense ratio. Let's take a quick look at these dividends that they've paid so far. So their first month, they paid out 50 cents, 51 cents, 51 cents again, and then their most recent dividend was 48 cents. They should be paying a dividend out next week. So overall, there's been some pretty good consistency with this fund. They paid out some juicy dividends so far, on pace for a 12% dividend yield, which is really good. And so far, not too much NAV erosion. All right, guys, we went over how this fund works, some of the risks. I do think NEOS, they have been putting out some of the best products. Want to see all the income ETFs that I own in my $230,000 plus portfolio? Check out the Patreon link below for a small-time YouTuber, and I will catch you on the next one.
Here's the reality. You're going to be poor for the rest of your life.